Hudson River, St. G. Welcome back, everyone. So, as for today's topic, what we're going to be discussing is essentially seasonal tendencies and some COT data, which is a part of what I use for making an analysis. I don't do it for every single trade. I just do it once or twice or 3 times per month, just to keep myself on track. And yeah, so we'll just start with the seasonals. So for some of you, it'll be quite confusing at first because there's quite a lot of lines, but I'll tell you how to look at it in the right way. So essentially what you want to be looking at is those 3 lines, right? So you would have your 33 years patterns, you would have your 15-year patterns, and you would have your 5-year patterns, right? And what essentially it says, it's a graphic that has been plotted all the way from 1985 up until 2017, right? There's newer ones, but I just prefer to use this one because I'm very used to it. It's not necessary that you keep changing it every single year, but if you do, you'll just get newer data. Like if I'm trading, I will change it, I think, every 5 years or whatsoever. So yeah, but nevertheless, so the way that this graphic works is that it's calculating the movements of the futures of a currency, right? 33 years in a row, back to back, right? So it's just back-to-back data. They do it for a lot of different currencies, but as for our examples today, it's going to be DXY, Euro, and it's going to be Swissy, right? And I will explain to you what you need to look at as well. So essentially, the one that you need to look at is a pattern, right? So what happens in the market, the longest pattern, right, that you would have available to you. So for us, it's 33-year pattern, right? So for 33 years in a row, the market was doing exactly the same thing. 15 years, right? So it's just tracking what's been happening in the 15 years, whether there's deviations, and 5 years, right? You would want to be looking at the black line, which is 33 years, and then just looking as well for 15 and 5 years and seeing if the market goes in the same way. That gives you an idea of what market is most likely to be doing within a certain period of the year, right? So we have our January, February, March, April, May, June, July, August, September, October, November, and December, right? So right now we're currently in the June month, right? Which is considered to be an okay month to trade. The best month to trade would be actually May, June, July, and August, right? September could be interesting. October, November, sometimes it just stays stagnant, sometimes it doesn't move, and then you would have some moves happening by January, right? December, like late November and December, professional traders, they barely touch the markets because it's just in preparation for the next month, right? What you guys also need to consider is quarters. So every 3 months, there's 4 quarters. Every 3 months, the market is going to be doing some new thing, right? So you can see January, February, March, right? By April, it's already gonna be moving downwards, right? Then you count April, May, June. By July, another thing happens. So if the market keeps on going one way, most likely in the next quarter, the market is going to be moving completely another way, diametrically opposed. And that is done to generate interest for people to enter the markets, right? And obviously, like they see, let's just say not dollar, right? But if they see gold keep on rising, they most likely by the end of the quarter, people will be saying, oh guys, like on CNN or Fox News, people will be saying like, oh guys, like gold is breaking the record standards, like it's just going higher and higher and higher and higher again. And people will be like, holy shit, well, look, I'm a bit late to the party, but I'll invest, fuck yeah. And so what happens is those people go and start buying, right? But nobody asks them, who are they buying from? Right? This is the most important question. And they're buying from financial institutions that use people for liquidity, use people for sentiment purposes, right? And then obviously, yeah, the market just goes completely the other way. And this is how retail crowd loses their money, and then they're going to be saying that 95% of the people lose. 95% of the people lose, but the thing is, who's on the other side winning? And that's what you want to know, right? Okay, so let's go back to USD, right? So we're in the middle of June. We're looking right now at those three graphs, and we can see that 15-year and 33-year, they're aligning quite nicely together. So 15-year shows a rise up, 33 years shows a rise up. So most likely in the month of June we would see the rise up. So at first the dollar would come up a bit, go down, take out the liquidity, SSL, come up again, come up, take out the liquidity, come up, come up, come up, and then the last wave is going to be in the beginning of July. And July usually is the month for dollar to start falling down, right? So okay, we analyzed that the dollar is going to be in strength for this month. This is when you analyze seasonal tendencies, don't take it as 100% certainty, right? Because market conditions change. There might be wars, there might be some political arrests, there might be different things happening in the world, right? But for 33 years in a row, right, the market tended to do exactly the same thing over and over again, year to year. It's the same movement, right? So this is why seasonal tendencies is something that you should be aware of, that they exist. You should check them just to see what the market has been doing in the past, what, 30, 40 years, up to you. By now it's already a tiny bit more than 33 years, but nevertheless, yeah, it's just important to see. But what you use this thing for is actually not only you will be tracking the direction of the dollar, but you can check which currencies are going to be weak or strong against the dollar at exactly the same time, right? So for currencies that are negatively correlated, right, you would want to see completely diametrically opposed chart showing the direction of the price action going in another way, right? So let me just explain it once again. So if you're tracking what the euro is going to be doing, right, and whether the move in this month is going to be quite hard, right, you would want to compare it to your base chart, right? So say for example we have our dollar, which is going to be rising up. You can see clearly that the dollar is just going to be supposedly going to be rising up, right? Whereas euro shows to be in a consolidation, right? It goes down, yes, but mostly it's just consolidating phase, so which is not going to be the perfect pair, because we would want to see something like this. Let's just let me just compare some months. July. Okay, so check this. Dollar on July, right? In the beginning of July, the dollar is most likely to start falling down, right? Which obviously, if you use inter-market analysis, intercorrelation, if the dollar falls down, right, euro becomes stronger against the dollar and it rises up. So we check over here, July, euro, futures for euro are rising up, right? Which is great. This is what you want to catch, right? So ideally, you want to be trading euro in July, right? Yeah, so essentially this is that for euro. Now let's look at Swissy. So June, all right, and DXY in June is also going upwards, right? So Swissy would be ideal to trade in the June month of any year, right? Which is nice. Okay, so we've done the seasonal tendencies analysis, and let me just arrange everything, and I'll be back with you guys in about a second, okay? Alright, so welcome back. We're continuing off with the bar chart website. So this is a website in which you can track COT data, which is commitment of traders data. As well as that, you can track the open interest, which is essentially all available long and short positions in the market, and you will track it via having a line that just shows whether those drop or they rise up, right? So what we're going to be focusing specifically on today is going to be just the COT data and the way that it operates, and yeah, I'll go over the main pairs that we would have to check. So first of all, what you do is you have to type in the future's name, the contract's name, right? So if we're checking the DXY, right, we would want to type in DX, one second, H, okay, this is March 2023, this is too much, one second, DXM, yeah, DXM 22, right? So it's the June 2022 contracts. We're still on June contracts, that's why we check. Essentially, you can look over here, you see at the bottom, I'll zoom in, over here. We would want to be looking at the volume. Whichever contract has the most amount of volume, that's the contract we need to be looking at. So currently it's the US dollar index June 22. So we click on that, right? And we click on full chart. And now what we need to analyze is the following things, right? So I have it already brought up to me, but for some of you guys, if you don't know, you can click on study, right? And in here you can type in COT, right, or commitment of traders, just the first one, it's going to be this one, COTLC, and the second one is OPINT, right, which is open interest, right? You can just click on this one, it'll add up as OPINT, right? As well as that, where you can type in %R, but we're not going to touch that for now, right? So essentially those two things will be brought up to you, and it might mean quite a lot of lines to you in the beginning, but I promise to you it's quite easy to read. So essentially you would have your zero level just about here. Anything above the zero level, that indicates net buying, and then anything below the zero level, it indicates net selling, right? So what do these three lines mean? They mean the next thing, right? So if you just click on COTLC, you'll be able to see that the red line means commercial speculators, so which is your financial institutions. This is what we want to do in this group. We want to track the financial activity coming from higher entities, such as interbanks, central bank levels, hedge funds, and whatsoever. Those are going to be your commercial speculators, right? These are the guys that actually move the market. It's not the large speculators, which are essentially people with $50,000 or more, or small speculators, which is your retail crowd, that drive the markets. They don't drive the markets. It's the institutes that drive the markets. It's the algorithms, right? They have their programs, softwares. They drive the market, not the common people. You're not playing against the common people in those markets. By no means. If you think that Elon Musk has said something and that's why a lot of people are just buying it and that's why the price goes up, you're completely wrong. You're not playing against people, you're playing against machines, right? So if you wanna play against the machines, you must think like a machine as well. On top of that, what our group does, we don't actually play against them. There is no point of swimming in the ocean and seeing a huge shark, right? And you being a little Nemo, right? Completely clueless and lost, to go and try to steal food from that shark or try to attack that shark, right? What's going to happen? The shark is just going to eat you, right? And you're a small fish that wants to be smart in those oceans of markets or forex or any other market that you see, right? So what you want to do instead is just let the shark go and enjoy their meal, right? Let them eat all the other fish, let them chase the liquidities, but you want to be either with the shark on the same team, or you want to eat the leftovers, right? And this is how you gradually will get yourself profits, right? You don't want to go against the sharks. If a bank is trying to long the market, why the hell are you shorting? That's the question, right? You're shorting with your $1,000 account, and the bank is longing with their $1 trillion account. So your $1,000 account will mean absolute jack shit. Like, in all thinking. So I hope this brings you a little bit of mentality that we have in this group. So yeah, small speculators, retail, large speculators, this is your 50k plus guys, and commercial traders. In all reality, I only look at the reds, right? It's just for this example I decided to bring all three because usually they're diametrically opposed. So check this. You see the price over here rising up, right? And as it rises up, you can see that the retail traders have been buying all this time. Essentially, you see a little buys over here occur, right? When the market started falling down, they decided to buy it once again at the bottoms because they think that the price will rise up. The people that will come with large speculators, those large speculators, they can be as private investors or they can be very low tier hedge funds with not a lot of volume. It's still possible, right? But big financial institutions is just low tier banks, interbanks, central banks, prime brokerages, and whatsoever. So you can see that starting from this level, right, it's been buys, right? The price has been rising up. These guys have been buying, but it's not them pushing it, right? What is actually happening right now in the markets is the following, right? You will see over here that ever since this buy has started happening, right, the price over here, the COT, has started lowering down, right? What does that mean? Okay, let me just click like this. From the entire prospect, even though the price is rising up, the price over here just lowers down, right? This essentially will indicate that there is a hedge program being in play as of now. So I wish I could draw somehow on this thing. Let me just click back on 6 months. Alright, so maybe I can do something like this. Alright, check this. And let me just click this and switch it onto I think it was brought up another thing. Give me a second. Okay, I think I managed to set this up. So let's just double check this. I just want to see it on my screen. If I draw, yeah, alright, perfect. So this works now. Yeah, essentially. So let's observe what's happening right now in the market, right? We see that the market has been steadily rising upwards and upwards and upwards up until this point. This is the same point that I indicated before in Swissy in yesterday's analysis. However, I would like to indicate it once again and just to explain it a bit further. So what we're looking at is a mitigation, first of all, right? The price has already been mitigated, but it's considered to be a low risk sell, right? Which is not your good moment to enter the markets, let's just say that, but it's still a viable way to enter the markets. You're just taking way too much risk if you enter the markets right here and then short on the retracement, right? You'll want to see some sort of confirmation, because what may happen is price go up, down, and then continue going off. If you're scalping, then yeah, sure, that's amazing. If you're playing long term, you gotta wait. You gotta definitely give it some time. So let's just analyze what's been happening over here. So all the way from this point, the market has been steadily rising up, right? And when the market steadily rises up, we need to essentially keep track of the left-hand side of the market, because whatever happens in the left-hand side, it will function with the right-hand side of the market. The buy side is going to be working with the sell side, right? And yeah, of course, it's markets, it's trading. You have to look on the left to be able to predict what's on the right. But no, this is not what I mean. So essentially what we're looking at is levels, specific levels, right? Where the market structure, MS, creates a break. So it's going to be a market structure break, right? We can see that over here, it's just been an upside buying, right? Buy, 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 buy. Essentially, this entire area is just buying. There's absence of selling, right? So every single time that somebody buys, they put a long position right over here, they put long position over here, and those little candles, like I said to you before, Sometimes they're propulsionary candles, right? But they're actually means of universities or financial institutes of hedging with the other left side. So for us now, it's all buying, but before this chart even existed, on the left hand side, there's been selling. So they're essentially pairing the orders. There must have been another place over there where it's, so this area would be slightly above it, right, where they just closed over the previous area. So if on that side they kept on selling everything, right, which we will experience in this side as well, on this side they're buying, right? So they were hedging shorts, but every single time that they were down selling the market for the market to go down, they were also doing something which we are talking about right now, which is hedging. So as the market was moving downwards, they will create a position. They will mostly go net shorts on the market, but at the same time they will align a little bit, like allocate a little bit of their funds for longs. So they have started longing way before we actually thought of it. And what they're doing right now with those little red blocks over here is that they're driving price down to the same areas where now they can put even more money on the longs. So each one of those red candles that you see, even though it's downwards, downside pressure, it's actually for them to long. And when they do long, that's why you will see those little wicks come out, taking out the liquidity from the markets, from the left-hand side with the wicks, right? Because if the liquidity is collected, it's accumulated liquidity, right? So from shorts that people can buy into, because essentially, if you're a long person, right, you would have your stop loss right over here, and I'll put it in this color. You'll have your stop loss right over here, and as the market comes and taps that stop loss, right, it's going to activate a market sell order, right? So if it's a market sell order, right, there has to be somebody to buy into it. And who's buying into it? Very nice, the institutes. That's what we're tracking as well. That's why every single time before I move upwards, there is a little wick that just takes the liquidity. Does it all make sense to you now? Yeah, we've been operating with this for years, and it's amazing, it's incredible, right? So let's continue going. So every single time that those guys, right, they long the market, imagine it in perspective of dollars, right? So dollar sign, bought over here, bought over here, bought over here, again taken out, bought over here. But if there's a couple of candles like this, don't consider this candle, just take it out, pretend it doesn't exist, consider those two candles, because those are your important candles, and this is where you're going to see your reaction, right? So essentially at this point, right, they once again bought, right? And when the price started moving upwards, just like this, right, their money that they have invested originally, and they invested right over here, suddenly becomes in plus. They're all happy, right? They're like, shit, fuck, we're earning money, this is great, right? But then the market cannot take the top. It just can't. Something happened, right? So what they do is they reconciliate, right? Some people that got over here will come over here and just, you know, mitigate the funds from long going into below their value, right? So let me just draw it like this. From long coming below their thing, the price comes up, they mitigate the funds, but the bulk of the volume is actually in here. So this is your important zone, right? You can play it in here, but it's advisable for you to play it exactly in this zone. So these guys went long, their money went upwards, they were really happy, and then their money just went downwards, right? So now their dollars are in minus, right? So what they do is they just wait until the price comes to the point where now they can just take out those dollars out of the market with $0 profits or minimal profits, and then they will change those positions from long positions onto short positions, right? And so once they change it from short positions, this is when the market can start moving somewhere downwards, right? Which is interesting. But what are we doing here? We're doing COT analysis, aren't we, right? So check this. As the crowd, the uninformed people, right? These are not your smart traders, right? These are very low intellect traders that read their data from Fox News, CNN, blah blah blah. They just trust anything that they want to trust. If they see Elon Musk buy a dog, they're gonna be longing the doggy coin, you know, like it's just to that level stupid, right? So as they see the price has hit their support, right? This is the common support resistance trap. It's a trap because the actual support and resistance, it does not exist, right? There is no support resistance in the markets. It's all fake. It's textbook material, right? So they're trying to long their support resistance at this point. They think, okay, the price is going to come back to support, and then I'm going to take my profits at the resistance, and then we're going to break the resistance and continue going higher. It's not going to happen simply because the markets right now need to mitigate the funds, right? So as those guys are now buying, and we can clearly see that they have been buying, right? COT data is essentially data that has to be presented to financial institutions by financial and regulatory authorities at the end of each month. If you're a corporation that works somewhere, you need to give your data of what you've been working on and what you've been doing and who's been using your platform, such as exchanges whatsoever, if those people are registered with companies or blah blah blah, at the end of each month. So this thing updates at the end of each month, right? And as well as that in real time, right? So you can just track it just like this, right? So technically we can see that there's a lot of these guys buying. Even over here, check this. You might think that this is a bit, but actually on a mass scale it's quite a lot. It's just a bunch of guys with like $20 wallets, you know, so it's not as big as it is right here. The retail traders have also been buying, right? But notice what the commercial institutions do. Right at this point, they sell. Do you see it? So as the price goes higher, these guys are selling. And you might ask yourself, what's the logic in that? Why would you be selling? You know, because they need to sell into someone who buys. And who's buying? These guys. These guys are buying. These guys are buying. So they're engineering the price to go upwards to make it look like the price is going upwards, while in reality they're selling. So selling, 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 and then guess what happens afterwards? It hits this level. What they're essentially doing right now is they're mitigating their longs, and they're changing them onto shorts, so that then they can drive the market lower. Because if you look at the market from the perspective of discount and premium, right? So which is premium over here, discount over here, premium over there, right? You're in the premium. You want to sell it so you can drive the price to discount and then buy in there, right? You're shorting. You're gonna make some real good money if you manage to drive the price. But at the same time, you don't just drive it to anywhere. You want to see precise spots where you can offload your money. So coming back to beginnings, where on this side do you see a spot where there's a lot of people with a lot of positions that you can offload your money into? At the same time, you would want to be able to fill some of the gaps in the markets where there's not been any selling power. So gaps in the markets, and a lot of people with their stop losses right in there, all waiting for these guys to come over there, and then these guys are going to be selling onto these guys, right? Or I'm sorry, I got a little bit mixed up. Buying onto these sells. Yeah, essentially. So that is your COT data analysis, and I hope that you guys liked it and it brought a tiny bit of sense to you. As always, enjoy your night and safe trading. I'll see you later.